Okay, okay, gang. Wanted to highlight a couple of things here today, um, given how we performed and uh, what things have done since the last time I did a video talking about this. So just want to point it out and give a little bit of a reminder that this is not only possible, but it is exceedingly simple if you just follow a couple of pretty easy to follow rules. All right. So if we look here first, let's just look up top. This is the S&P 500 ETF, and you can see we came back here to this kind of value channel, I call it, and managed to get a nice turn to the back to the upside and take off new all-time highs. If you recall, there were lots of folks who were calling this, the beginning of the end, and we're going lower from here, and we're going to crash, and yada yada yada. So I am not a perma bull. It is going to happen at some point. We're going to get another crash. That's just how markets work. But it wasn't this time. And not only was it not this time, but as I said before, we kind of bounced from here and took off and made new highs, new all-time highs. So, the market is to be applauded for that. Again, here, if you recall, the last, I think, update video I did on this was right here on the 30th of September. And we came down and I pointed out that we basically stopped right at this level, right at the low of this candle right here, right? And I wasn't sure if we were going to turn. I wasn't sure what was going to happen the next day, as it were, October 1st. But it was interesting to me that we put the brakes on and we were able to keep from dropping even further, right? We opened the next day, got a nice bounce back to the upside. I think we actually opened and took out the low and then bounced back to the upside, but we didn't take out the high of this candle. Let me spread this out a little bit. We didn't take out the high of this candle. No, I'm sorry, of this candle, right? So that wouldn't have been a signal, right? Like it was over here, right? When we gap down, crash, tried to put in a hammer pattern, ultimately took out the high and bounced back to the upside, but couldn't stay up, right? So we came down here, took out this low, didn't take out the high before that or after that, for that matter. So we were back into wait mode, right? Got another drop here, took out the low of this, of the first. This was a Monday, October 4th. Put in this low, and then on the 5th, right, we went on and took out the high here, which would have been an entry, given how this looks, right, with your stop back here. So an entry of 433, call it 434, with a stop at 426, right? And you can see what you've gotten here, right? So the return on your risk would be not too bad, right? So that's that. What I really wanted to point out to you guys, and what the title of this video is all about, is using leveraged ETFs. You could have done much better, right? Without much, if any, additional risk, right? So the first thing to note here is we did get this crash in the same way, right? Came down and actually came inside this channel, right? And that is because of the sheer magnitude of the volatility, right? You get 3 for every 1, or 3% for every 1% move up or down in T triple Q. So the Qs, if they move up, oh, of course. Sorry. When mom calls, one must answer. So if you got a 3% move in either, a 1% move in either direction, here you got a 3% move. So that means the volatility is higher, right? So that pushed the T triple Qs into its own rising channel, right? Because the moves were a bit more dramatic. But that too becomes your advantage on a move to the upside, right? Now this is the weekly, right? So again, whatever percentage return you get from the triple Qs, the T triple Qs target about 3x that. Okay, so you'll see here, right? You had basically the same thing that you saw on the S&P 500 ETF, the SPY, right? You got the gap, bounce, gap down again, came down, but this entry was a bit cleaner, right? Because here's your candle, here's your trigger candle, right? Took out the high right here, got you in at 125.5 with the stop at 116.45. So you're talking about not a little over $9, I think, right? So that's your risk, right? But here's your return, right? Because it never took out that low, and you would still be in it. So I ran the calculation earlier, and you'd be up about 35% in this puppy, right? On that one trade, right? From again 125.5, and we closed today at 169.93, and that, of course, that's if you're still in it, right? But again, not too shabby, right? So yeah, I don't want to overextend this, right? But that's the name of the game, right? $9 risk, and these are the kinds of plays that you're looking for, right? Now, in truth, you would be up about 35% on a portion of it, right? Because as you advance in your swing trading, you're going to learn that one of the best things that you can do is pay for your risk, right? And just ease out of a bit on the way up, so that you really take all of your risk off the table, maybe take a little bit of profit, but really take all your risk off the table, and allow the remainder of the position to do whatever it is it's going to do, right? Until it violates whatever exit rule you have in place that takes you out of the trade, right? But that's all talk and lesson and stuff for a different day. What I really wanted to point out here and have you see that this was literally 35% off of a single trade, right? You would of course have to negate if you were using the same strategy, right? You would have gotten taken in over here, right? And depending on how you played it, this could have been a total loss, right? Unless you exited some at some point on this move up, and then got taken out of the rest of it once it came back here and broke this low, right? But let's assume, for the sake of assuming, that you left the entire position on, so you would have had a 1R loss, right? But here you would have made up for it, more than made up for it. And depending on, again, how you play, you would still be in it. Okay. So anyway, that's it. Hopefully this is helpful, and just gives you a better eye and view toward what's possible and what you can do. If you have any questions, you know how to find me. Barring that, we'll see you next time. Take care.